Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you're with us today, both myself and my co-host. We're both financial advisors. Right there makes you excited, I know, because who doesn't want to hear from financial? I mean, where could you even meet a financial advisor, right? I mean, you're not going to see him at like a friend's party or anything.
They're not going to tell you. They're not going to give you a business card that turns into a sponge. Wow, the financial advisor is here.
Oh, it's another financial talk show. That's amazing.
That's right. Great. You've got to hear this.
I got to tell you, it seems to me, Pat, that most financial shows are not good at all.
Well, ours, people may be thinking the same about ours. So we just started it.
No, I mean,
we're not pitching annuities or life insurance policies here.
Okay, thanks. We don't have a vested interest to try to sell someone a product.
Yeah. We'd like it if you became a client of the firm, but that's not the objective.
That's part of the objective. We're totally honest. Okay,
right.
that's part of it.
So anyway.
But our point is we want to make this a decent program. We both are practicing financial advisors, which means that we've got a lot of experience with this stuff. And we come here every week to help educate you and get you better.
But we're not going to. Anyway, we're just going to give you our advice. And if you want to call our firm, then call our firm. If you don't want to call the firm, don't call the firm. That's simple.
Well, the interesting thing when someone hires a financial advisor, it's not like a typical transaction where I'm buying a set of tires or something, right?
You're going to work with them for a long time, and you're going to expose parts of your life
that are very private,
extremely private,
and it often goes both directions. You talk to a financial advisor, you're saying, do I want to hire this person? Do I trust him? Do I trust her? Are they competent? The advisor's looking at you and thinking, well, that person followed my advice. Can I get this person to change this aspect of their finances? Will this person be respectful of my time, respectful of my staff? So it's typically, you might not realize it,
but you're interviewing each other.
You tend to be interviewing each other. And if you find yourself, by the way, talking to a financial advisor that you doesn't feel like they're going through that process and just trying to sell you something, that might be a sign like,
move on.
Why do they want me? They don't even know me, and they're trying to talk me into becoming a client. How will they even know they're going to like me as a client? Right?
Yeah.
Anyway, I don't know why you started the show this way.
Well,
we did start the show. Anyway, we're going to take some calls to join the program, 833-99-WORTH, 833-99-WORTH. And you might find a few of these calls we've got sprinkled in with some best of calls as well as our summer schedule is happening. So we're talking with Chris in Colorado. Chris, you're with Allworth's Money Matters.
Hi, thanks for having me.
Hi, Chris.
Hi. So I had a question for you guys. By the way, I really enjoy your show. I
Thank
listen
you.
to it when I'm exercising on Saturday morning.
Oh, good.
You do what?
Yeah.
When do you listen to it?
She's exercising.
Oh, isn't that? I love
yeah,
listening to podcasts when I exercise, when I bike ride.
Oh, yeah.
Absolutely love it.
But I always learn something from you guys, so
good.
I'm really excited to be on here.
Oh, good.
So here's my question. You know, I listen to a lot of people that call in, and a lot of them are in way better financial shape than I am. I hear about their big pensions they're going to get and how much money they have saved, and we're not doing too bad. But I just wanted to ask your advice on pretty much all of our money is in retirement accounts.
Okay.
And we probably have, I'm 50, almost 57, and my husband is 1 year younger. And we have about 1.1 between all of our retirement accounts.
Okay.
And our goal would be, we've always talked about this because
By the way,
both have
Chris,
parents.
if you look at the majority of Americans at 57 and 56, nowhere close.
Nowhere
As a matter
close.
of fact, I think the average 401k balance is under $200,000.
Yeah.
So
You're doing great.
Yeah, I feel good about it because neither
there's
of us
always
are,
someone with more.
Yeah, there is. But we're definitely middle class, and so I feel good about the fact that we've really sucked down and saved.
It's not easy
But
accumulating
so I'm
that
kind of
amount of money.
nervous. Oh, I'm sorry. What was that?
Oh, wait.
It's not easy to accumulate that much money. It takes sacrifice.
I know.
Yeah.
I know. It does. It does. But so anyway, I'm a little nervous just because the stock markets are so high right now. And I just wanted to ask your advice on maybe right now we've been somewhat aggressive. We have I looked over all of our accounts. We probably have about 75% in stocks and maybe only about 25% in bonds and other. If we're wanting to retire, we want to retire a little earlier just because we both have parents that had poor health young and we want to enjoy life.
Mm-hmm.
And so maybe in 6 to 7 years, are we being too aggressive there?
Have you?
Well,
what was your allocation a year ago?
The same.
How about
Same.
3 years ago?
I
mean, have you rebalanced this?
It's
So
even higher. Yeah, I do. We probably had even a lot more in stock, probably closer to 90%.
And tell me what your debt looks like.
We only have just our home, and we owe about maybe $120,000 on it.
And what's the value of the home?
Probably about $450,000.
And what's the interest rate?
We just refinanced, so I think it's 2.7 or something.
Oh, you
like
are
that.
poster. You are such
And
you.
we did 20 years because we actually made that bad decision when you're young. We refinanced a couple of times and took cash out and did 30 years again. And we would have almost had it paid off by now if we hadn't done that.
whatever.
You do a great job.
And
I don't think your allocation is too aggressive.
So think about the investments are based on two things primarily. One is time horizon, how long you have before you need the dollars. And the second is your tolerance for risk, your ability to withstand the ups and downs in the market. And what we know historically, over long periods of time, owning those companies that produce things, owning the large companies in the United States, the smaller companies in the United States, owning stocks have produced a return much higher than just about any other asset class. Broadly diversified, done about 6 percentage points above that of inflation over the long period of time. Over the short period of time, it's anyone's guess. Matter of fact, historically, about 1 out of every 3 years, the market finishes negative. About 1 out of every 3 years.
I guess I remember how devastated we were, and I think it was 08 or whatever.
And what did you do?
We lost so much money. And
what did you do?
I thought, oh my gosh. Well, I was stupid. I kind of panicked a little bit and went more conservative.
Okay,
and then, of course,
all right.
when everything rebounded, then I didn't get the gain.
That's right.
So I didn't panic in 2020. So that was good. I left it alone.
I'm gonna restate. I said earlier that you were good. I'm gonna change. I'm gonna change. Here's what I would do. If you were Chris, if you were my little sister, this is what I would tell you. I would amortize that mortgage over the next 7 years and pay it down so the day you retire, the home is paid off.
Assuming you're going to stay in that house or that area.
Right? So that's number one. So I forget what the length of the mortgage is. I would just go to a financial calculator, put in my remaining balance, and figure out what the monthly payments will be so that the day I retire, the home is paid off. And the second thing I would do is I'd rebalance this portfolio to go 65% stock, 35% bonds and cash. I'd visit it twice a year to make sure those allocations were correct.
And maybe have all of your new deposits go into 100% stock.
Fair enough. But I would move it down to 65-35.
But it's helpful to think about it like this, too. Let's say you retire in 6 or 7 years. You're not going to spend this $1 million your first year in retirement.
You're not. In fact, that 35% that you have in bonds will allow you to take withdrawals regardless of where the market conditions are in the equities.
You could go 10 to 15 years before touching stocks, which is, matter of fact, there's never been a 15-year period of time where stocks have not outperformed bonds. And in an interest rate where bonds are almost nothing.
And the rest of it's emotional. And you know that how you reacted in 2008 was emotional.
But when your accounts are mixed, like a 401k with a bunch of different things, and you make withdrawals, You can't. Can you choose which
Oh, yeah.
fund you're withdrawing?
You can, but
yeah.
also,
I didn't know that.
by just doing a simple rebalance each time, it accomplishes the same.
But no,
objective.
you
But can.
absolutely can. I mean, you absolutely can. In fact, when you retire, you're going to actually move that money out of a 401k into an IRA, and you have even more flexibility. So the idea of leaving money in a 401k is it's antiquated.
Well, it's an easy
okay.
approach.
You wouldn't do it,
Of course not.
right?
But if
and
someone
I
is
think
an
one of the
unsophisticated
little
investor, has
side
no one to
questions-
trust, it's not a large account, that's why.
But Chris is bright.
I understand that.
I mean, the mere fact that she knew her allocations is impressive.
And you learned a lot through the financial crisis.
Oh yeah, I really did. And that's why I didn't touch it in 2020. And I'm so glad because I had all
Right.
kinds of people telling me,
It was hard.
You got to move to cash.
But
And-
you think about this,
Don't
though.
listen to them.
These right interest rates right now are how much do you earn in the bank right now?
what was that?
How much do you earn on your money that's in the bank right now?
Not even 2%.
Okay. Correct. Nothing, right? Those returns you received last year is because you own stocks, and the cost that there's a cost. There's no such thing as a free lunch in anything in life, right? So the cost for that is for you having to withstand and endure the ups and downs of the portfolio. That truly is the cost.
So
when you
excess returns over cash, the cost is risk.
And that risk, if you're diversified, the risk is really a short-term decline. They always have been short-term decline. But if you think about it, like, wait a minute, that's right. This is what I'm paying for those extra returns. This level of uncomfort I have to deal with, that's the cost I have to pay to get the excess returns. If you can view it that way, then the next time there's a downturn, you won't have the same reaction. You'll say, wait a minute, I've lived through this before. I realize that these are temporary. It's going to look different next time. It's going to be ugly. Who knows when it'll come, but it'll come. It's going to look ugly. Your friends are going to tell you, Chris, you're crazy. You're so close to retirement. Why are you betting your retirement? We pulled our money out last week. You're foolish. You'll hear all those things.
You know, Chris, on a personal note, when the markets tanked last time, I increased my equity exposure significantly.
Well, all of our clients did because it's through our rebalance process.
Understand. But where I would normally be 60% stock in my own portfolio, 70.
I can't say all, but anyway.
70 to 30. I have no emotional attachment to my own portfolio whatsoever. I just don't. It doesn't bother me when it goes down, and I don't get excited when it goes up. But the last decline and in the last economic crisis, at the same thing. I just this is the greatest time in the world to buy.
Yeah, I actually did that. Because I was one of the ones lucky enough to have my job all last year, so I actually increased and just was buying in my 401k.
Brilliant.
I figured this is the time, right?
Thank you.
Brilliant.
Brilliant.
It'll eventually go back up, but
Maybe I changed my mind again. I think you might be 75-25 for the long term. Seriously.
I gotta get more brave, I guess.
It's
It's
all
a
based.
It's a life lesson I learned the hard way, for sure.
Right.
That's good, though.
That's good.
Better
right?
to learn it now than when you were 42 as opposed to 57.
Yeah. But the only thing I would do is keep it between 65 and 75% stock.
And think about how much money that is outside of the stock market, right? Make sure you're fairly conservative on those things. And then when the markets are falling, and they will, I don't know if it's this year, next year, who knows, right? But considering the last 20 years, we had 2 declines of roughly 50%. If I were planning my retirement over the next 20 years, I would plan there's probably going to be a couple of declines of close to 50%.
Would you worry about it?
No, I wouldn't worry about it.
Why?
Because there's nothing I can do. That's just the reality.
That's-
and I know that timing the market doesn't work. There's no, if we could say, look, now's the time to get out, now's the time to get in, that would be fantastic. But nobody can do that successfully over the long period of time. They might get lucky once or twice.
As was evidenced by 2020 when the markets went on an absolute tear, fastest bear market in
The shortest, the quickest recovery ever.
ever. And
I
if
was
you,
shocked.
yeah,
We were
right?
all shocked. I'm in the industry and I was shocked.
I was having a conversation with a friend 2 days ago. I said, I don't understand how this stock market is doing as well as it's doing. And he said, well, this is what you do for a living, Pat. I'm like, yeah, but
Well, you do understand because you understand what drives it's human emotion.
That's right.
It's behavior. It's herd mentality. All those things are what drive prices short term.
I don't understand how it's doing so well when the fundamentals aren't there.
If one thing this shows you that fundamentals and prices are totally irrelevant to one another over short term.
Do you guys think there's going to be a big crash?
Oh, I know it. I know it. Absolutely know it. But I don't.
I believe it.
That's look.
But I believe the best way to go through that is not to try to time it. It's to have your long-term investments ride through the storm.
But Chris, the question isn't do we believe it's going to happen, because we believe it's going to happen. The question you should be asking is when.
Yeah.
And I have no idea. Not a clue.
You shouldn't be asking. It doesn't matter. If your portfolio's set up in such a manner, you've got the discipline going in, you rebalance periodically.
How many times did we rebalance our portfolios?
3 or 4. All of our qualified accounts.
Everything in IRAs, which means
the vast majority. There might be some outliers, so I don't want to put.
Okay. So what that means is that you know how you look at your portfolio and you measured your stock to bond ratios, right? We rebalanced our portfolios 3 to 4 times last year.
In February, because the markets had run up and our stock exposure got too high, not because we thought the downturn was coming. It was just the fact that, look, if someone was supposed to be 60% in stock, their portfolio drifted to the point where they're 64 or 5 or whatever the number was. We sold off some stock. And it wasn't because we were predicting the peak. It was just that now we had a higher percentage than we want. Then was the plan.
We had a discipline going in.
Then the market had this tremendous sell-off so quickly, we did another rebalance like 3 weeks later where we bought more stock. Not because we saw the bottom coming or we knew that this was the bottom. It was just now that we had less than 60% because the market's full. So we sold off some bonds, bought some more stocks, and just that process of a rebalance.
It did well. It was great. But you should have the same discipline if you're managing your own money. And I think you have the ability. So quite frankly, you should run your portfolio through a screen 4 times a year.
Okay.
A minimum of twice.
And I think over the next 20 years, you would be better off sticking in 75% stock.
That's right.
But you have to realize that you're going to see some bigger swings in that account. And it could be next week. Nobody knows. And I would anticipate a 50% decline in stock values.
At some point in time.
Just because we had it twice the last 20 years. Why wouldn't you anticipate
by the way,
it happening?
Chris, you've done a great job with your savings.
Yeah.
You should be proud of yourself. You should go back to your husband right now and just say, I'm a stud. I do a great job.
Yes.
I know he said, I told him I was going to be on your show. He's like, oh, I'm going to have to get your autograph after.
Right?
Yeah.
Good
job.
And I am the saver. He's great about just letting me handle it, because even with his, I get on and I just increased his to like 17%. You know, I'm always trying to.
Oh, good.
You know, he would spend it all if he could, but he.
But we do like to Pat's point. Well, good. You probably balance each other out. He helps you have a little fun sometimes. To Pat's point, if you can swing it to where you get the house paid off by the time you retire.
Brilliant.
Even if you took slightly less deposit in your 401k to get it done.
Exactly.
It's just you need less money in retirement.
That's right. Money not going out in retirement is exactly the same as money coming in. And having no mortgage at the house.
That's great advice.
Well, thank you.
And then I don't know, do I have time for one more side question?
Go ahead.
Sure.
So my husband does have a pension because he works at a large hospital system in the Denver area that he would get. And it's nothing next to the pensions I've heard people talking about on your show. But I guess I'm a little nervous because I wonder, is there any chance that could go away?
Yes.
I mean, if it's a reputable company, is it
We
most likely
said yes,
something
I said no.
No. It's guaranteed by the PBGC, which is the Pension Benefit Guarantee Corporation. The smaller the pension, the bigger the guarantee is.
So I would not worry about
it. Can it happen? Yes, it can happen.
Statistical chance.
It can happen.
The statistical chance of if the company went bankrupt, the Pension Benefit Guarantee Corporation took over the obligation for them not being able to make the benefits.
My own father worked at Levitt's Furniture. You remember You'll Love It at Levitt's. His check in retirement came from the Pension Benefit Guarantee Corporation. The company was insolvent.
Does Levitt's no longer exist?
I don't.
You love it at Levitt's.
I don't know. All I remember is we could get furniture at cost. That was the best thing about my dad's job at Levitt's. But his check came from the Pension Benefit Guarantee Corporation. The smaller the pension, the older your husband is when he retires, the bigger the guarantees. But these airline pilots that were forced into retirement at age 60 that worked for United and American, they had substantial decreases in their pensions.
It's similar. Think about it like the FDIC insurance on bank accounts.
So if his
limit.
pension's less than, let's say, $2,000 a month, I wouldn't worry about it.
Nope. I'd have no worry.
Yeah. Well, that's good. And Social Security is a whole other story. We probably can't really count on that.
Yeah, now you'll be fine. You'll be fine. You're 57. The benefits of Social Security, the day you should worry is when they stop sending checks to people that make over $100,000 a year. And that will happen. There will be a time where they
At some level.
it needs based Social Security.
I don't know how else I don't know how else we navigate through it.
Yeah.
There's only so much you can tax young workers.
So I appreciate the call.
Let's talk now with Samantha. Samantha, you're with Allworth's Money Matters.
Hi, Scott and Pat. Thanks for taking my call.
Thank you, Samantha.
My husband and I have been discussing whether or not we should keep our 30-year term life insurance policies.
Okay.
Currently, we have 10 years left, and the policies are $200,000 each. We pay a total of $650 a year.
A year
A year.
on each one of them.
No, between the two. For
No,
both.
total.
Okay.
So we have, for the next 10 years, we'd be paying $6,500 for the next 10 years.
How old are you and your husband?
I'm 49. My husband's 51. We plan to retire in about 3 years. We don't have any dependents. Good health. Own our own home. Still working right now, but
And if you're let's heaven forbid your husband died today, from a financial
heaven forbid.
we're talking about life insurance. I mean, so he died. I mean, that's what we're talking about, right? If you're
Yes, we are.
yeah, that is what we're talking about. So he dies today. From a financial standpoint, would you be? How would things be for you?
From what I gather, if he dies today, because we work for the state of California, that I would be getting a monthly payment of $2,500 plus like a set $5,000, from what I understand. But that is, and that's till the day I die that I would get that monthly payment.
And both you have
But
normal health?
Yeah, we're both in good health.
Have you shopped this at all? Did you go to
Pardon?
Have you?
No, they've had it for 20 years.
No, I know, but have you gone to see what it would cost to replace it on Select Quote? My guess is it's going to be more expensive on Select Quote.
It might be more expensive today.
I mean, well, the reason that we actually had gotten these policies was back 20 years ago was when we got the home, when we purchased our home.
Yeah, I understand.
How much do you guys owe on your home?
Zero. We own it.
How much do you have in your 401ks or 457s? Between the two,
about 1.7 total.
Yeah, I can't.
And you both have pensions?
Yeah.
Yes, we do.
Yeah, I wouldn't.
And you're both vested? Your pensions?
Yes.
Yeah, cancel.
I wouldn't have them. You
Yeah.
wouldn't buy these today.
You wouldn't buy them. You don't need them.
I mean, the reality,
Okay.
life insurance is designed to replace an income stream that's tied to someone's life, right? So that either through wages or through a pension that would cease upon someone's death. But if you're both in a situation where a survivor would receive a survivor's pension benefit,
And you have that much money in your 401k or 457, and your home is paid for, and my guess is that you're saving significant amounts of money on a monthly basis. There's no need for it.
That's true.
Right?
Okay. Yeah.
that's it.
Yeah, no. So even if I, let's say, kept his policy,
If you
I'd
want.
still be good.
Yeah, if you
No,
want.
I'm kidding.
If you want. Just don't tell him.
But
And actually,
no, I think
Samantha, and another day, I'll actually take 20 minutes and you can call me and I'll explain the history of life insurance. To you.
no, I mean, you bought a term policy because you needed it for a term of your life, right? You need it for a certain period. You didn't need it. You don't want to pay for a whole life policy that's going to have to cost you a fortune, knowing the insurance company is going to pay it when you're 90 years old. So you've satisfied that period.
Yeah,
You just so chose to have a 30-year.
and the term is, and you
don't need
achieved
it
your
anymore.
objective in a shorter period of time.
Yeah, I'd cancel it.
Cancel.
okay.
All right.
You could choose to
Pretty
get a
much.
physical ahead of time to make sure there's nothing weird, but probably.
Oh. I actually didn't think of that. I mean, I was just kind of, like I said, we were just kind of discussing whether we should keep it or not. Because I mean, we're, for lack of a better way of saying it, we're thinking, why should we pay for
Odds are,
insurance?
What's the chance of them paying it out? It's almost zero. You're paying $650 a year for $400,000 worth of life insurance. You think there's a good chance you get dying in the next 10 years? No, it's minuscule. No. You can just tell by your premiums. No. So
but don't call them and cancel. Just quit making the premium payments.
Oh, just quit paying.
Yeah, just don't pay it anymore. Let it lapse. Yeah. That way, if something happens to you in the lapse period, you still got coverage.
That's right. Okay.
That's just squeezing the last little dime out of that thing.
All right, Samantha. Glad you called. Wish you well.
All right. Thank you very much.
Right. Well, we need to take a quick break. This is what we're supposed to do in the program. And when we come back, we'll continue on with Allworth's Money Matters. Stick around.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Hey, we want to talk, at the end of the program, we're going to spend a couple minutes on the Federal Reserve and which was called Quantitative Easing. I don't think you hear that much going on, but that's essentially what they've still been doing, going out and buying bonds, and now that we're expected to reach $9 trillion by the end of next year. So we'll talk that, and we're going to listen to some great calls here in the program. So let's talk with Charles. Charles, you're with Allworth's Money Matters.
I'm approximately 2 years away from retirement, and I'm looking at moving out of the country and retiring in Southeast Asia.
Okay.
And
Which country?
I'm looking at Thailand. So my question is, I have a 401k that has approximately $130,000 in it, and I'm thinking of using it to buy a condo over inland.
How old are you?
I am 64.
And where will your income come from once you retire?
I have basically, I'm going to get Social Security, approximately $2,500, and I have an annuity with an income rider of $250,000.
What's the income rider?
It would bring me $1,000 a month.
And are you single?
I'm single.
How long ago did you purchase this annuity?
5 years ago.
So, and how much would the house cost you?
Approximately, probably at the most, $100,000 for a nice one-bedroom condo over there.
And do you own a home here?
I own a condo in Sacramento, and it's paid clear.
And what would you do with that condo when you moved to Southeast Asia?
I'm thinking I would rent it out here so I can make a little income off of that.
And what's the value of the condo?
$160,000.
And how much income does it produce?
Nothing now. You're living.
If I was to rent it, I could probably rent it out now for about $1,400 a month.
What'd you pay for it?
I paid sickening $30,000 for it.
Oh my! Let's talk about that.
From a short sale.
Let's talk about that real quick. So, if you sell, let's say it's 2 years from now, you're retired. If you sold that condo, all that capital gain that you just $130,000 of capital gain is forgiven because it's been your primary residence. If you convert that to an investment property, and down the road you sell it, all that gain is going to be taxable to you. Unless you
own it till you die.
The challenge I like where you're going with this. The challenge with the 401k is it's although it says it's $130,000, it's not really $130,000.
Right. Especially if you take it out all in 1 year.
You've got a silent partner. someone's got to pay for this COVID relief bills, right? So, but the challenge is that tax on that $130,000 might be anywhere from 12% to 30%, depending on how much you take in any one year.
And what other assets are there in the household?
That's about it. I have savings with $25K.
Okay. So
I wish all your savings wouldn't tie them to this annuity.
Yeah, but Scott, that's
Right.
the first place I'd go because he bought it
How
5
old are
years
you?
ago.
I'm 64.
Yeah, he bought it 5 years ago. There's a surrender charge on it. It's probably 7 years. Right? So there's so many ways.
You got to look at that annuity.
There's so many
first.
ways you could. The first place I would go is the annuity. The second place I would go is if I couldn't.
100%.
The second place I would go if I couldn't do the annuity would be probably taking a new mortgage if you decided to hold this condo, which may or may not be the right thing based on tax, and that you'd have to decide that you're probably going to own this until your dying day.
And I have no idea what foreign ownership of condos is in Thailand. The local rules are.
Understood, but the condo that he's got living in now, whether to convert it to a rental or not. But what would be wrong with actually either taking the money out of the annuity, which is, by the way, the first place I would look. First place. I wouldn't go further than that. Unless there were big penalties on this annuity, depending upon how bad the damage is, which is one of the reasons we don't like annuities, is because they're expensive many times, not always, but many times to get out of. The other technique you could do is you could take a new mortgage out on the existing condo while you live in it.
Yep.
Right? And then you could actually use the distributions from the IRA over periods of years in order to pay that mortgage down.
So have your 401k, let's say the mortgage payment's $600 a month, have the 401k, take the same $600 a month out of that 401k to make that mortgage payment.
And that way you're not driving yourself up into a higher marginal record. But
you got to look at the annuity.
But my guess is that it may be a combination of two of these. But the first place, if you were sitting in my office,
sometimes that annuity, the benefits might be significant enough that he's single and to actually keep it there.
I know, but he only bought it 5 years ago, and it's got a guaranteed minimum income benefit rider on it, which sounds. And he said it's $1,000 a month on a $250,000 annuity, which is 4%. So
you need to sit down with a financial advisor and dig through all this stuff.
Yeah. If you were sitting,
not someone who's going to sell you an annuity product.
Yeah. If you were sitting in my office, I know exactly the chain of questions I would go through. First would be the annuity. What's the cost to get out? What's the value of the GMIB, the guaranteed minimum income benefit? What is the cost of that? If it's not too expensive to get out of that, then we would just hit the annuity, pay cash for the house in Southeast Asia, Thailand, call it a day.
Right.
Then we discuss the tax implications of converting the condo into a rental property,
and the
ups and downs.
With the annuity, there could be the problem with these contracts. They're so complex, and everyone's different. But sometimes, if you take out more than say 10% of the contract, it collapses all the guarantees that you've got built in place. So you've got to. That's why they're really easy to get in.
They're hard to get out of.
So you got to be.
Okay.
So we're not big fans of those products because of some of these reasons.
But
now you own it. So now we got to figure out the best way to manage it.
But the question you called with is, can I use my 401k?
It'd be the last place I'd go.
It'd be the last place I went.
Okay.
The last place.
And odds are either one of two things, my opinion. If you're my brother, I'd say either sell that condo here and use those dollars, or get a mortgage on it. Probably now, while rates are low, we know what they are.
Yep.
Right.
Then let's take a distribution once you retire from that 401k to cover that mortgage payment.
Yep. And or the annuity. Take a distribution from and or
one
the
of the
annuity.
reasons I was trying to keep the condo is because in Thailand, if things change or
when they
the
change,
world change in the future, I could always come back.
Okay, well then you answered the question there.
Then definitely
now
keep
we strike that one off the list of alternatives. So now we're down to, right? You're not going to sell the condo. Do you put collateral? Use the condo as collateral,
or just take the
money out of the
part
annuity.
of it, if your annuity has been aggressively invested, markets are high, good time to take some cash out. That's probably where you'll end up. But you got to look through all these things and really dig in to see if you take the money out of the annuity, what are the costs, not just costs and surrender costs, what are the costs as far as what's it going to do to the guaranteed income benefit that you've got built in there?
But the answer to your question is no on the 401k.
Don't take a lump sum on that. You won't have enough money. The taxes will eat you alive on it. It'll be disastrous. So.
All righty.
You can't take it in 1 year. It just does not work well. So glad you called, Charles. We're talking now with Steve. Steve, you're the Scott Hansen and Pat McLean, Allworth's Money Matters.
Hi, Scott and Pat.
Hi.
When I retire in the next year or so, I should have about $750K in my 401k. And I'd like to take about $100,000 or $200,000 and put it in a home improvement vacation fund. But with the remaining money, I need about $2,400 a month additional income to supplement my pension. Is that doable?
So, first of all, taking the money out.
Well, when you say taking the money out for home improvements, you mean cashing out the 401k, paying taxes on it, and then doing the home improvements. Is that what you're saying?
Well, I'd rather convert it and not pay the taxes up front and just have that money sitting in an account that I can access it easily.
So you're not going to recognize the gain. In your mind, you're splitting the IRA up, one to provide income or the 401k up, and another part that you can draw on for supplementary expenses.
Correct. So I'd have about $550,000 that I would somehow need to get net $2,000 a month.
Yeah, I don't think that's a 4.3% distribution rate. I don't think that's unrealistic, depending upon how the portfolio is invested. You have a pension as well, right?
A very small pension, yeah. But I've gone over all of our finances, and this is what I've come up with. I would like to supplement about $2,000 a month net.
How old are you?
58.
And when do you retire?
Well, I was going to wait till I was 59 and a half, so I don't have to suffer the 10% early
And
withdrawal.
how much is your 401k balance today?
$760.
Okay. I was just concerned that you were expecting it to continue to grow another year.
And have you
No.
have you factored Social Security benefits into this?
I have.
Your income?
I have. Yes, I have.
I mean, so if you were 68 with a larger pension, I'd be much more comfortable. 4.3% sounds like a low distribution rate, but the challenge, we're in a very low interest rate environment right now. I'm confident that over the long term, you can do that and have it grow with inflation. But in order to do that, you have to have the portfolio has to be invested with some stocks in it. It's going to be volatile, and you're going to have to be comfortable living with that.
And are you going to lower your monthly distribution once Social Security kicks in, or are you going to keep it the same?
I'd like to keep it the same. I don't actually need $2,000 a month, but in order to sustain the lifestyle we're used to and maybe have some extras.
What do you owe on your house?
$220,000.
And with the repairs you planning on doing to the house, the challenge is taking $100,000 or $200,000 out of the 401k is all going to be taxed as income. So you might end up losing 40% of that, depending on how much you take out in any 1 year. I think you could probably accomplish the things you want to accomplish.
It's tight, though.
It's a little tight. I mean, if you worked a few more years, here's what I would highly recommend: have a financial advisor that specializes in retirement planning. Create some plan, not someone who's selling product, by the way, because guys who sell annuities and stuff. I
have my 401k is through Fidelity, so I have been speaking with.
Yeah, but they're not
Fidelity.
They're just talking about investments. What you want to do is what if scenarios.
Planning all this out, right? When Social Security kicks in, what's that going to look like? Like maybe you take a little more from your 401k between now and the time Social Security kicks in, and then lower it back down. Like, so you can do a lot of different what if scenarios. What if you left today? What if you worked for another 4 years? And you can map all that out so you can make an informed decision. I would approach it from that angle first, and then back into these other
because the scenario you laid out is possible, but it is tight.
It's not. It would be a horrible idea to take $200,000 out of your 401k in 1 year to do house. It would be the worst way to pay for it because of the tax consequences.
Well, I don't really have any home improvement. I was just calling it a home improvement / vacation fund that I would like to set aside.
So you don't have it earmarked for anything?
No.
Oh,
I feel much more comfortable with that.
If I were to walk into your office today and give you this scenario, would you be able to sit down with me and on paper show me how I would have this supplemental income for the rest of my life?
And more so probably using a software program where you can play different scenarios.
Yeah, you sit down
and what happens if you have another financial crisis occurred, and so how would that? And so the idea is to give you the highest probability of success in retirement. Any good financial advisor, any good financial plan is really about probabilities, having the highest degree of probabilities for success in retirement. So that's what as financial advisors, we care about when you're 68 or 78 or 88 and making sure you're in the right place there. So I would strongly recommend going through that financial planning process. I mean, you're like, it would help you, whether you or not you just chose to hire an advisor, I think it would help you immensely just going through this process. All right.
The problem is not many people are having in-office visits right now.
Oh, they can do it remotely. We have 70 advisors across the U.S. that are doing these meetings remotely.
And that will change probably within weeks. We're going to Joanna. Joanna, you're with Allworth's Money Matters.
Good morning, gentlemen. How are you?
We're good. How are you, Joanna?
Good. Let's see. I have a question in regards to purchasing service credit. I work for the state of California. And so I have 4 years of service credit that's available to me to purchase.
Understand this. You left the workforce at some point in time and cashed that in. Is that why it is available to purchase?
It's available from my military.
Okay, thank you. Bridge. It's bridge service. Okay, perfect. Thank you. All right, the question? I know what the answer is going to be.
I do too, but go ahead.
Ask the question.
Oh, okay. Well, my question was just, is this something that I should be looking into?
Buy as much as you possibly can.
And if you don't want to do it with your money, I'd love to do it with my money. Let's work out some sort of a deal.
All day long.
Okay.
It's that good of a deal.
It is unbelievable. It is the highest rate of return you will ever get on your money. And when it was available, they used to be able to buy 5 years of service time.
This is for the state of California's plan. I'm not going to state for other.
But if you work at a municipality or a government where they offer you what's called service credit that you could purchase, or in this particular situation, it's bridged for Joanna, they're unbeliable rates of return. So now,
kind of like 8% with the guaranteed cost of living adjustment.
Yeah, and the reason is because the formulas for your pension are based on years of service and age. And if you look at the grid, the further you get up into the right, it accelerates really, really fast. So anything you could add to that actually helps you. Now, the second question is, what money do I use to purchase this, right?
Exactly.
Do you have money in a 401k now? Or 457?
Yes, I do.
How much?
Total, I'd say about 38.
All right. And what's the cost of the bridged 4 years credit?
It is $44,868.
Okay. And so do you have any money outside of the 457 that you could use?
I have a separate account through Allworth and Fidelity.
And how much is there?
I'd say about 60,000 or so.
Perfect. And how's it in? It's not in an IRA. It's in a brokerage account, correct? It's outside of an IRA, or it's inside an IRA?
It is I think it's a traditional, and then I have a Roth IRA.
Okay. So you could pay for it two ways. Scott, do you have an opinion on this? I'm thinking that she just takes it out of her paycheck to do it.
Yeah, how much is it if you take it out of your paycheck?
A month.
It depends on definitely the month. So if I were to do it it says for even here 15 years.
How old are you?
Almost 44.
Yeah. And have you bought it over 15 years? What would that cost you?
It would be about $400.
And what's the cost of money on that? Do you know? Is it 3% or 2%? So there's a.
Yeah.
So
it
what
says
happens?
It says 7% interest.
Okay.
Then
All right.
we don't want to buy it over time.
We don't want to buy it over time. You're going to use the money at Fidelity, the money in the IRA, or
If you have an account, it's what, 44,000 you said?
Yes.
If you have one account that's $44,000 or slightly higher, I'd use that account.
That's right.
Just to make it simple.
Yep.
I would definitely
Okay.
buy this.
Yeah, and I wouldn't buy
Joanna,
it over time.
I feel so
wow.
strong. So at Allworth, we manage close to $11 billion for our clients. If I could take that $11 billion and run it through your scheme, we would have every penny invested in these.
Every
pension
dime. When this was
Oh, wow,
available
okay.
years ago to our clients, I used to call it
Because
an
it used to be
IQ
you could
bet.
just buy extra 5 years.
5 years.
An additional 5 years. You didn't need to bridge service or have a gap in service. You can buy an extra 5 years.
Yeah, and we did it.
I had
assuming the
arguments with many
clients-
clients like, trust me, I want you to take the money away from me and put it there. You're going to earn more there.
Assuming they had a normal life expectancy.
Yes.
Okay.
All right, so do it. Use the money in the IRA, and if you need any help, just call our office, and we'll have someone walk through which
Yep.
account to use. And you'll just email
That's
over
great.
the accounts, and then they'll tell you exactly which ones to use. All righty?
Perfect.
All right.
Thank you so
Yeah.
much,
All
Joe.
right. And thanks for your
you called.
service.
Yeah. Yes, thank you for that too.
Thank you. Thank you.
We're talking with Rick. Rick, you're with Scott Hansen and Pat McLean, Allworth's Money Matters.
Hello, how you doing?
Hi, Rick.
What can we do for you?
How are you?
We are good.
Okay, this is a tough one, I think. I don't know. My mother-in-law owned a condo, and so some 20 years ago, my brother-in-law had the idea of putting the condo in his name as my wife's name in case something happened to their mother. Well, 20-some years later, she's still kicking, and they had to put her in a assisted living, so they had to sell the home to pay for it.
Uh-huh.
And now we're probably going to get taxed
Oh, yes.
on that amount.
That's right.
And it's not that they want to keep the money. I mean, the money's for her care, but the more we pay out in tax and everything, the less money we have for her care. And the way she's going, she's 103, and she ain't going
103.
anywhere right now. Yes, and she's healthy as can be.
How long ago did your brother-in-law do this?
He did it like 20-some years ago.
Yeah, that was a bad
He
idea.
was in their 80s.
What was the value of the
It
house?
was a very bad.
What was the value of the house then, and what's the value of the house now?
Well, it was valued around $80,000 then, and now it's valued at they sold it for $249,000.
But your cost basis is lower than 80 grand because
That's
it's
right.
actually whatever your mother-in-law's cost basis is.
And so it could be 20. So you might have a $230,000
Let's
capital
call it
gain.
a $200,000 gain. That's $100,000 that flows through your tax return, and $100,000 that flows through your brother-in-law's tax return.
And capital gains and then state income tax. Is there a way around this, Scott?
The sale's already done, right?
The sale took place?
Yeah, well, they had to sell it in December.
So
Yeah,
it took
'cause
place.
she was
So
already in the-
it closed escrow in 2020.
Right, and she's been in the nursing home since like June or July of last year, and all the money, I mean, is in her checking account and goes to her care. So they pay her monthly expenses for the assisted living out of that money.
Yep. And
I mean, they haven't taken a dime and probably won't.
yeah, well, it was a bad idea. It was some amateur
we've
estate
seen it.
planning. I just don't know if there's a way around. It might make sense for you to reach out to.
What are you going to do? It's 20 years.
Yeah.
It's not. It wasn't mom's asset any longer. 20-some years ago,
Yeah.
she gave her condo to her two children. They were kind enough to let her live there until
Without rent.
she couldn't be there anymore. Now she's not there. They sold it. It's already done.
Yep.
It's sold. There's capital gains to report. There's no way around it.
And she was the only one that lived in the house.
Yes,
Yep.
she was the only one. Yeah.
Yep.
I mean, you could have structured it in December. You could have figured out if there's a way to do an installment sale and sell 50% in December of 2020 and 50% in January of 2021, and you could have split the income out over 2 years. That's what I would have looked at the time.
That's pretty smart, Scott.
And I would have probably only accepted offers that would be willing to accommodate that. But
It's done.
it's a hot real estate market. But it's done.
It's done.
done. Yeah.
Yeah, it's going to cost you probably, I don't know, 25 grand.
Depending on what
So is it smarter
state is.
to divide it between the two?
Well, it
Well,
is
yeah,
divided
it
between
is
the
divided.
two.
You don't have any choice.
50-50.
Yeah, right.
Yeah, you don't have any choice in the matter. Yep. Unfortunately,
Yeah.
this is I have seen this, I don't know, a dozen times. Dozen times. Always after the fact, by the way, because when we see it before the fact, we actually fix it.
Yeah.
So
Sorry, Rick.
appreciate the call.
Yep. All right, we have a couple minutes left. We said we want to talk about this. Here, if you remember back to the financial crisis, the Federal Reserve, trying to do everything they can to keep the economy going, started buying bonds in the open marketplace.
The financial crisis, not the COVID crisis.
No.
This is going back to 2000.
Called quantitative easing. And what happens when the feds, when they do that, they buy, let's say, a U.S. government bond, they take that bond out of circulation and they put into the market cash. It adds cash to the market, expands the cash. Well, it was supposed to be wound down after the financial crisis, never quite got wound down. And then when our response to the pandemic, it
started again.
In
but you didn't read much about it.
Big ways.
So in the first financial crisis, when did they start buying it? 2009?
Yeah, 2009.
Is when and you'd hear QE1,
QE2,
QE3,
now like QE45.
Right? You don't hear much about it anymore, but it has continued
Not really 45,
to the pace of $120 billion a month buying treasuries and mortgage-backed securities. What this does is it keeps interest rates on the longer bonds artificially low.
That's right.
Well, I shouldn't say artificially low. It keeps them low. But if they weren't buying it, the interest rates would be higher, therefore slowing the economy. And the question is, shouldn't we be slowing the economy a little bit now? Maybe we should let the natural forces take place?
You think? You think government intervention here is good for the long term?
You got to worry about inflation with this.
Yep. It's something to keep an eye on. It really is. Anyway, we're out of time. It's good being here with you. This has been Allworth's Money Matters. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.